Hey everybody, I hope everyone is doing well and had a good day. In this video, we're going to review the E-mini S&P 500 5-minute chart for Wednesday, May 20th, 2026. Let's see the daily chart, higher time frame context. We have a tight bull channel, and now we have a 4-bar bear micro channel. If we pay attention to the structure through here, from the high close of the rally, we had a gap down and a follow-through bar, so that's a bear spike. And then from the close of, this was last Friday the 15th, so May 15th, to the open of May 18th, Monday of this week, the market gapped up. That's an implied pullback. So we have a gap down, that's a breakout, implied pullback, a second push down to the low of Tuesday, and then a rally into the close. That's another implied pullback on the lower time frame. And then the gap down on Tuesday, yesterday. So it's basically a spike, pullback, and three-legged channel. You could connect the lows of these bars and have a bear channel line, which we'll see on the 5-minute chart, or maybe we can look at the 15-minute chart. But on the daily chart, we don't see any of the pullbacks. It's simply a 4-bar bear micro channel. But I think the structure is important because we had this initial burst of momentum, a shallow pullback, and then a couple of pushes down to this support, the start of this final micro channel in this rally. So now we have basically 3 legs down to support. The expectation here, probably buyers below yesterday's low. And yesterday was a trading range day. It's a bad buy signal bar, so there's probably sellers above the bar. It's a trading range bar. However, the structure makes sense for buying because the tight channel is likely to get a second leg up and a test of the highs, and this is more likely a minor reversal. Here's the 15-minute chart context as we go into the day. Here's that support on the daily chart. Here's the channel line that I drew on the daily chart connecting the lows of these days. You can see the market testing the bear channel line repeatedly. And there's also increasing buying pressure. Pretty strong rally here, the strong rally yesterday. So stop order bulls, even on the 15-minute chart here, are making money. So it started as the big gap down, spike, pullback, and channel, pretty tight channel through here, but increasingly became more and more two-sided. And the expectation is that the channel evolves into a trading range, and that's why I have the high of the Tuesday's bar marked on this chart, or this was actually Monday's chart. The high of Monday I have marked. There's 2 ways to look at it. When a channel evolves into a trading range, you expect the beginning of the channel to be tested. So it's a spike, pullback, and this is a highest point and the start of the channel down. So this is a magnet as well, but I just have the high of the 18th marked because it was more relevant for today. Now for the 5-minute chart. Going into the day, it's a gap up, and we look at the 5-minute context. We had the strong rally. This was a major support on the daily chart and a very strong rally, that 15-bar micro channel, followed by the deep pullback, and that's the channel. We have lower lows and lower highs. In theory, the bulls have a stop below bar 33 or the low of yesterday. And based on this chart, they were able to defend those stops. So if you have a stop loss below 33 or yesterday's low, the market never reached that stop loss, which means 78, and then the gap up is a higher low. The channel down is fairly tight. There's pretty decent buying pressure along the way. This is a pretty strong micro channel. You don't get bars like 68, 69 in strong bear trends. But in a leg in a trading range, you might get these deep pullbacks with strong buying pressure, bull bars closing near their highs here. The gap up is immediately testing resistance. So I mentioned the micro channel here. The close of 69 is probably resistance because Well, it's a pretty strong micro channel, but the context is bad. It's following this bigger sell-off, the bigger tight bear channel. Any trader who bought bar 69 was trapped by the reversal, 70 and 71, and then further selling. So the expectation here, as bar 1 is testing the bar 69 close, is that you have bulls who bought 69 who got trapped on 70 and 71 with the follow-through, and whoever bought there is trapped into a losing position. And when the market comes back and tests their entry price, if they, in theory, they use a wide stop scale in lower, they're probably happy just to get out at their original entry. Also, if we talk about the structure regarding major reversals, in this case, it's a bear trend and a trend line break. Usually, the market tests the trend, the old trend's extreme before reversing in a major way. So I do not expect this tight bear channel to reverse immediately into a strong bull trend. At a minimum, there's probably going to be more sideways price action, trading range, probably more sideways before the bulls get any kind of reversal. Again, the micro channel yesterday, that's a very strong breakout. Trap traders down here, and a second leg up is likely. Trading range bar and bar 1, probably sellers above, like I mentioned, we're testing resistance. And because of the gap up, it's a strong enough bull breakout, the gap up from yesterday's close to today's open, that there are trapped traders now below. And this is support. So the breakout point, bar 78, high, any of these bars highs, or the close of yesterday, I expect all of these areas down here to act as support. Bar 2, it's a bear breakout, but testing that support. It's also a breakout of the bar 1 trading range bar. In a trading range, traders buy low and sell high, so there's probably more traders buying below bar 1. It's not a very good stop order sell signal bar, and because of the gap up and the trap traders, like I mentioned, there might be more traders buying around here. And then 3, bull breakout bar. It's a strong bar for the bulls, but there's a lot of overlap, and that's a problem. Again, it's testing that resistance, so we can see, will the bulls give up here and sell, or will the market break out above that resistance? And bar 4, it broke out above the resistance, but then closed almost on its low. A good distance for the bulls. Now it's a 3-bar micro channel. Price moved a long way from the low of bar 2 to the high of bar 4, but the selling pressure, the selling into the close of bar 4 is a problem for the bulls. It does not look like bulls are aggressively buying into the close of bar 4, but instead they're buying pullbacks. They bought below bar 1, and they scalped out here as we tested more resistance. So bar 4 is a strong enough reversal. If you look at a lower time frame chart, it's a bear breakout. It's probably going to get at least a small second leg sideways to down. Looks like a trading range open, buyers below 1, sellers above 1, probably buyers below 2, and sellers above 4. Trading range bar, high 1, but in the trading range, probably sellers above 4 or 5 here. And then an inside bar, 6. Inside bars in trading ranges just tell you that the market is going sideways. It's a trading range. We can see that. There's a lot of overlapping bars with big tails and small bodies. And 6, just range compression, a lower high and a higher low. Probably sellers above 6 and buyers below 6. 7's a breakout bar. Any trader buying below 6 just got trapped on bar 7, and that might be enough fuel to get a second leg down. It's also a micro channel. Technically, we're getting lower highs since bar 4. No high, or I should say, every high is at or below the high of the prior bar. So it's a micro channel from bar 4 to bar 7. It's probably going to get a second leg down. Structurally, it's already 2 pushes, 1 pullback 2. So there might be some buyers here. But I wonder if the traders come in and buy lower based on this structure instead of buying here, maybe buying below bar 3, a strong bull bar, or even below bar 2. A follow-through bar for the bears. That's good for the bears, but it's a smaller bar. And as we approach support, I expect traders to be buying down here. So the downside is probably limited. And then 9 went outside up. 9 tested that support, the bar 78 high breakout point, bar 81 high, also a breakout point. The breakout I'm talking about is the gap up. So bull breakout, gap up, functionally, they're the same thing. It's a breakout pullback second leg, but fairly tight and not quite a micro channel because bar 2 pulled back below 1, but a fairly tight channel from bar 78 to bar 4 today. And this is a pullback testing support. I talked about the major trend reversal structure, fairly tight bear channel. Bulls got a decent trend line break here, far above the moving average. Price moved a long distance from, here's one way to draw the trend line for the bears. Market broke above the trend line, tested it, and then rallied far above it. So at this point, the market's either in a trading range or a bull trend because it's no longer creating lower highs and lower lows. We broke out above this lower high. This was a major lower high. Lower highs, lower lows, strong breakout to a new low. This is a major lower high. The market broke above it, so it's no longer a bear trend, but a trading range or an opposite trend. So in this case, a bull trend. It's certainly a trading range open. The bulls are hoping it's a gap up and a double bottom bull flag on bar 9. And putting in, again, the bulls hoping they're putting in an early low of the day and a swing trade here. It's possible that it's another expanding triangle open. Kind of like yesterday, we talked about this. But I also talked about this yesterday. So it was an expanding triangle. Higher highs and lower lows, but the sell-off down to bar 8 was strong enough that the first reversal attempt back up would probably fail. And now I'm saying the same is true, but opposite today. Expanding triangle, lower lows, higher highs, but so much momentum, bars 9 and 10, especially bar 10, that breakout bar, that the first reversal down will probably fail, and the bulls will probably get a second leg up. Inside bar, it's a sell signal bar, but like I said, the first reversal will probably fail and be a pullback, minor reversal before the bulls get trend resumption. Good risk reward, but low probability. Relatively small risk if you sell below bar 11, with the hope being the expanding triangle structure continues and the market gets all the way down, back down below bar 9. But in that case, you're making 2 or 3 times your risk. And the only way you get good risk reward is if the other side of the trade has the high probability, which means selling bar 11, you probably have a low probability of winning that trade. But you make up for the low probability, the low win rate, with the good risk reward, the 2 or 3 times your initial risk. And then the market goes immediately outside up, 12 and 13. Market looks like it's respecting this bull channel line as it tests it on bar 13, breaking out to a new high and then finding sellers again. But look at the selling pressure from bar 9 to bar 13. There's only one bar for the bears, and it's a smaller inside bar. So some traders will take the low probability swing trade, maybe even selling with limit orders above bar 10 or below bar 11, bar 13. But if you're taking the sells, you're trading against a strong bull breakout where it's really difficult to make money selling. You have open breakout gaps, like this is a micro gap. The high of bar 9 and the low of bar 12 do not overlap. Bar 10 is the breakout. The pullback does not overlap the breakout point, bar 9. So you have traders selling above 9, trapped by the bull breakout, unable to get out at their original entry, and that creates more fuel, more buying to the upside. The bears who sold and got trapped have to liquidate their position, exit their shorts, and that contributes to the buying. And the bulls are always buying, and they're buying because strong momentum on the breakout 10. They're expecting at least a second leg up, which they got 12 and 13. But now again, like I said, 13, another low probability sell, probably buyers below 13. The market tests that below the bar. It's a bad stop order sell. And there's buying into the close of bar 14. Going sideways for a few bars here. I think the bears are still hoping. They're hopeful that it's an expanding triangle and we get this big bear breakout down to a new low. But the selling pressure is just so weak here. We do have to respect the bull channel line here. There's probably sellers above 16, but really nothing great for a stop order sell. So it's always in long, okay to be long here. And 17, another bull breakout bar, probably going to test at least a little bit higher, maybe break out to a new high and find sellers there. 18 breaks out and then pulls back. It's behaving as channels behave. Bulls are buying pullbacks and taking profits at new highs. So the bulls buy the weak stop order sell below bar 11, and then they exit, they scalp out when the market tests above bar 10. They buy again below 13, another bad stop order sell, and it looks like they're scalping out again above that high, bar 13. 19 is a more reasonable sell because it's a bear bar closing on its low. We have at least 3 legs up here. But the channel up is so tight, I think it's better. As far as selling 19, I think it's okay to exit longs below 19, but to go short below 19 is aggressive, and again, you're taking a lower probability trade. Good risk reward, you put a stop above 19, sell the close, or sell below bar 19 with a stop order. You stand to make maybe 10 times your initial risk. However, if you stand to make 10 times your initial risk, you must be taking a lower probability trade. The only way an institution is going to take the opposite side of that trade is if they have high probability. There's no such thing as a perfect trade, so you never get great risk reward, small risk and big reward, and high probability. There's always a trade-off. The sell triggers below 19, but it's a bad entry bar for the bears. If always in bulls exit below 19, they can buy in above 20 for at least a scalp to a new high. And that one didn't trigger until bar 22. 22, the biggest bull bar, or one of the biggest bars in this rally. Now we're about 20 bars into the rally, and we're testing a major resistance area. You can see this line I had. This is the high of May 18th. The bulls are breaking above the channel line with 3 major legs up, and again testing that major resistance. At a minimum, I expect a pullback here. Sometimes a buy climax like bar 22 here, as it's several bars into a bull trend. Sometimes that will lead to a reversal, climactic reversal into an opposite trend. But the selling pressure, I mentioned it on the way up here, has been pretty weak. The bears never had consecutive bear bars. There's open breakout gaps created by the bull breakouts. So this is a breakout on a higher time frame, and the buy climax will probably attract profit taking from the traders buying. They suddenly get a windfall of profits. They're going to take profits here, especially when it's breaking above a channel line and a major resistance level. However, more likely the market goes more sideways here and transitions into a trading range rather than continues in a very strong or even stronger bull trend or reverses into a major bear trend. The expectation here after this climactic bar, in short, is a trading range sideways. Bears get a breakout 24, but testing support, the breakout point created by bar 22, probably buyers at the high of bar 21. Also, like I said, I'm expecting the market to go more sideways here, not reverse into a bear trend. So 24, it's a good looking bear breakout bar, but it's probably minor and part of a trading range. and then it fails to get a good follow-through bar. Strong enough selling, it'll probably get a second leg down. It's testing this breakout point, the low of bar 23, created by the breakout bar 24. So there might be sellers, maybe sell the close 25. It's a two-legged pullback. So from the high of bar 22 down to 24, it's a 3-bar micro channel. Now it's a two-legged pullback, testing resistance. The bears will probably get a second leg, at least sideways, maybe down. Now the bulls have a micro channel. It's a tight channel from 24 to 29. So this is confusing. It's a trading range. Big down, big up, buy low, sell high, and scalp. The upside is probably limited. Major reversal or major resistance here. So as the market gets closer to that resistance, there's probably going to be sellers of bars here. Trading range bar 29, probably sellers above. Bear breakout 30, probably sellers above. Maybe sell the close 30, but also okay to sell a pullback because the micro channel is strong enough that it may get a small second leg. And that may be all the bulls get for their second leg. Micro channel. It's basically, if you look at a smaller time frame, it's a bull trend line break, and then a retest of the highs, testing that breakout point here and finding sellers at the low of bar 29. And then 33, the bulls are hoping, like I said, it's a tight channel, and they're hoping it's a double bottom bull flag. 31 and 33 is a double bottom. So there might be traders buying above 33, looking for a second leg up, but the bears now have a fairly tight channel down from 29 to 33. And then we got the bear breakout on 34. Any trader buying bar 33, front running the bull breakout, just got trapped by the bear breakout 34. Bulls hoping that it's a double bottom bull flag. Now we get the breakout below. It's possible we fall for a measured move, and this double bottom becomes resistance because the bears got a breakout and then follow through. And there's the measured move down. Just about testing that measured move from 29 to 31. The smaller measured move based on this neckline certainly got reached from, bar 32 and 33. So fairly strong micro channel, 32 to 35, second leg down. Likely the first reversal up is probably going to fail. So traders can sell above any bar here, expecting the bears to at least get a second leg. Selling here may not be ideal because it's testing support. 36, a buy reversal bar closing above its midpoint, but another additional bar added to the micro channel. Like I said, more likely sellers above 36 than buyers. Too much momentum. Usually the first reversal fails. The bulls need a trend line break and a test of the lows before they can get their major reversal most of the time. And then the bears, like I said, 22, the high of 22 down to 24. That's a micro channel. This is a pullback, and that's a second leg down. They seem to be similar in size. So it's close to a leg 1 pullback, leg 2 measured move. So some support here. The leg 2 measured move, the bar 20 low. We may bounce here. 37 triggered the buy and then immediately failed and went back down. So that's bears selling the first pullback, looking for a scalp. Whenever there's a high probability event, the risk reward is really bad, and that's what we're seeing here. I said it's more likely the first reversal fails, which means there's a high probability limit order sell above the bear bar, above the first pullback, and that's above 36. So bears can set a limit order here to sell, but their target might just be the low of bar 36, and their stop is at least up here above 32. And then a bull bar as we test below 36. So we're finding support at the measured move and the support based on the bars to the left. Bar 39, strong bull breakout bar. That's a good bar for the bulls. Relatively small overlap with the prior bar. It's a fairly big bar and it's closing on its high. It's probably going to get a second leg up, but there are problems with it. You can see it's testing that resistance that I pointed out. It's also about a 50% pullback of the sell-off. That's a typical resistance area. This is a tight bear channel. There's probably going to be sellers at the midpoint of it, looking for at least a test of the lows one more time. And because it's a trading range, if we just look at this, I said it's more likely to be a trading range after the buy climax, and that's what it looks like through here. This looks like a trading range. So traders are buying low and selling high. So to buy here on 39, you're forced to enter in the middle of the range, and that's really not ideal. Instead, bulls might buy below the bar, maybe buy below bar 39, or at least buy in the buy zone of 39, the bottom half of it, maybe the high of bar 38, breakout point. But what I'm getting at is that buying 39 is really not ideal because it's testing support and it's in the middle of a trading range. And whenever it's a trading range, you should be thinking buy low, sell high, scalp. So the market immediately pulls back on bar 40. What about selling bar 40? Well, now we have the bear trend, and I always talk about the smaller time frames because it's a bear trend on a smaller time frame. On the 5-minute chart, it's a trading range. It's just a couple legs down in an overall trading range. But on the 1-minute chart, this is a pretty long bear trend. And what happened was it's a bear trend for how many bars? Let's see. About 27, maybe 30 bars. It's a bear trend for 30 bars. And then you get this trend line break. And the trend line break is pretty strong buying pressure, 39, retracing half of this trend. That's enough buying pressure to disappoint the traders selling down here, which means, let's imagine it this way. If you're selling, it's a low one short, bar 37. Let's say you're selling bar 37. You get filled on 38. And then you get bar 39. And you just sold. You're disappointed because you're trapped into a losing position. You never would have sold 37 if you knew you were going to get bar 39. You would have sold the pullback instead. So the traders who sold down here are trapped by the bull breakout. That's strong momentum by the bulls, and it's probably going to get a second leg because of those trapped traders. So when the market comes back and tests support, the expectation is that you have trapped bears who sold, who are disappointed by the breakout, and when price comes back and tests their entry price, they're going to buy back shorts. And then you have the bulls who are buying low in the trading range who are contributing to the buying as well, and that produces the second leg. So probably more traders buying below 40. The market actually gets below bar 39 on 42 and continues to go sideways. Limit order market, there's probably sellers up here above 40 and buyers down below bar 38 and 42. The bulls finally get their second leg, 45, and there's sellers above. You can see, based on the tail on 45, sellers at the close above 40. Again, it's a limit order market. It's a trading range. It's fairly tight. It's only taking 2 bars to go from support to resistance. A couple pushes down here, 2 legs, but each leg is only 1 bar. Bar 40 is a leg. It pulled back. Bar 42 is a leg. Bar 45 went from support to resistance in just 1 bar, so it's really not a good stop order market. If anything, if you're going to trade this tight trading range, it's a limit order market. Traders will sell above bars and buy below bars. So probably sellers above here, 48 breaking out, but probably sellers above. It's a trading range and a limit order market. And if you did sell, let's say you sold above 45, maybe you made a quick scalp. But otherwise, if you're holding that short position, you might be disappointed with bar 50. Market continues to go against you if you sold, and that creates support here. So the downside here might be limited because now, look at the momentum. It's a pretty strong micro channel for the bulls. Market rallied, sideways, rally, sideways, rally. That's 3 pushes to the top of a trading range. The high close of 28 is significant. That's relevant to talk about. Tight bull channel, decent breakout follow through, 27, 28. If you buy the close 28, it's the same but opposite that I was just talking about. If you bought 28, you're disappointed by the reversal here. You're very disappointed by this sell-off. And any trader who bought 28, maybe they use a wide stop somewhere down here. And they scale in, they buy more lower. What's a trader going to do if they bought 28 and the market comes back to their original entry price? They look to get out here, especially when the structure is 3 legs up in a trading range. That's a fairly tight, it's a micro channel. The selling pressure is weak, so it may pull back here, but 45 through 50 may get a second leg to the upside. It also helps for the bulls that they have this big tight channel earlier in the day from bar 9 to bar 22. So probably a minor reversal, 51. But you do have trapped limit order traders hoping for a reversal back down to the middle of the range if they sold here, but the market continued to go higher. So we're starting to bounce here. We're testing support once again. The moving average is support. This tight trading range, 46, 47, is also support. Market went sideways, think got a bull breakout. So probably buyers around here. The micro channel gets a second leg and then reverses up 55. But it looks like the trading range is continuing. It looks like, yeah, this micro channel will probably get a second leg, but the upside is probably limited because it's a trading range overall. And in a trading range, you want to buy low and sell high. So I'm keeping that resistance level there, the bar 28 close, because market reacted to it on bar 50. And if we test there again, there's probably going to be sellers there again. The bulls get a breakout. There's probably buyers below 56. And the stop order below 56 triggers. It gets a second leg down, but now we're testing support again. The low close of 53. Market reversed up, pulled back a significant percentage of this sell-off, maybe 80%. So when it tests there again, there's probably going to be buyers here. And then the bulls get their second leg. So bull breakout, micro channel, two-legged pullback, second leg, but back at resistance. So a pretty strong looking micro channel with a structure of 60 through 62 is really strong because other than 60, 61, 62, very little overlap with the prior bars. Bars are pretty uniform in size, closing on their high. It's really a good looking breakout. But you have to take context into consideration, the bigger picture. You'll see that it's leg 3, testing resistance, so it's really not great to buy here. It's possible this is a bull trap, trapping bulls into buying too high in a trading range. Maybe it's trend resumption, breakout, sideways, pullback, and then a big leg up. But until there's a breakout, we have to treat it like it's a trading range. And again, it's buy low and sell high. And then right now the market is high in the range. So probably sellers here. And then 63, a big breakout bar. I think 60 through 62 is strong enough that this reversal 63, although it's strong, it's a strong bar, it is testing support. There might be buyers below 63. It might be an upper range as well. So instead of this entire, like down here being the low, maybe the low of the range is right here. And the downside here might be limited. It's a little more of a bullish environment. It's a spike, pullback, and channel. You can call it a channel here because it is creating higher lows and higher highs. And 63 is testing closer to support. And 60 through 62 is strong enough. It's probably going to hesitate at least before it reverses back down. 63, strong enough bar to trap traders above. That creates resistance above and a second leg sideways to down likely. Tight trading range continuing, probably sellers above. There's that resistance from before. So again, imagine if you bought bar 62, you buy the close 62, and your entry bar is 63, you're disappointed. You're trapped into a losing position if you bought 62, and 63 is your entry bar. So when the market tests there again, it's no wonder that price tested that price and then reversed. The approach there is another micro channel, 64 through 67. So there might be more traders buying below 67. We're getting later in the day, and it's a really tight trading range through here. It's really not ideal for trading. And if you are trading, it's better to use limit order entries because stop order entries will get you chopped up. This is a limit order market, sellers above bars and buyers below bars. 63, again, 63, it pulled back almost 100% of the bar. And that's disappointing if you sold 63. If you sold 63, like I mentioned, you're selling closer to support. But if you did sell and maybe you scale in higher, like at the close of 62, you might be so disappointed by the extent of that pullback that you look to exit at the average entry price, which is the midpoint between your first entry, sell the close 63, and your higher entry, sell a close of 62, and that's the purple line. So that might limit the downside and create more of a second leg sideways than down for the bears, and that's what ended up happening here. 63 should have got a second leg, but instead, market rallied and broke out to a new high, breaking out above this tight trading range. A pretty strong rally, tight channel here to 74, but testing that major resistance, the high of May 18th once again, so there might be profit taking from the bulls here. You can see the market drifting sideways to down as traders take profits at that resistance. It looks like a minor reversal. Maybe it's a pullback before the bulls continue to get trend resumption. Maybe it's a wedge bull flag before this micro channel or this tight channel gets a pullback and then a second leg up. But in this case here, we just ran out of time. All right, that's going to be it for today's end of day review. Thanks everybody for watching, and for more Brooks price action fundamentals and how to trade price action, you can visit the Brooks trading course link in the description of this video to learn more. All right, thanks again everybody for watching, and I hope everybody has a good night.